get signed in and get acclimated to the platform. But thank you for joining us on Facebook. Certainly, we want to be able to reach you in a lot of different ways, depending on where you live online, whether it be you like to watch these things recorded afterwards, you like to come through Zoom, you like to go through Facebook. We want to make sure there's lots of ways that you can view our stuff and hear from us. We like to communicate with people. So let us know if there's anything that you need in the meantime.
And as always, if you have questions or comments, please put them in the Q&A section. You can find that at the bottom of your screen. That way we can address your questions as they come. One of those nice benefits that you get to doing it live.
Absolutely. So we like questions, we like interactive stuff. There may be questions that you have afterwards, of course, and you can always email us, call us. We try to keep ourselves pretty available to be able to do that on the fly, but certainly taking some moments in time. For things like this, we like to do our halftime presentation, our forecast presentation. Those are things that we've done every year since Keystone started back in the day, back in 2010. We started these presentations pretty early on. So a couple of times a year, it's a good opportunity to check in and, not only have you hear from us, but us hear from you as well. We like to hear your comments, your questions, your concerns. Nobody knows what the future is going to look like exactly. So this is just us telling you what we think and also hearing from what the experts are saying. So we'll get started here in just a second. And one thing that you should know too is that these are recorded. So on our YouTube channel, you'll be able to go back and view this later on today. And it's very shareable. So we always want to make sure that you're sending this on to people that you know that probably should have been on today. They probably should have been listening to this. And as you're listening to this live, if you want to pass that on to them, just know that'll be available later on today.
Absolutely. That's a good plug for the YouTube channel as well. And we have a lot of videos out there, not just this one. Any past things that we did, forecasts, anything like that. You can go out there, share them to people.
Oh, you can see how right or wrong we were. We can go back and listen to all of our presentations.
How that might be a fun little experiment.
It could be.
How right were we?
Our YouTube channel, by the way, and social media, easy to find. Just go to keystonefinancial.com, upper right-hand corner, little icons up there, Facebook, Instagram, all the different things. So Facebook is the one that we're on right now. For those of you who are on early, also for the YouTube channel, there's a little YouTube icon that you can click on. It'll pop up into YouTube and you will see all of our past videos, including this one later on today.
Absolutely. Feel free to share.
Yeah. So we'll give people just a few more seconds here and then we will start recording and get going. Again, remember that there is a chat questions feature for those of you who are on live. You'll be able to go in, ask questions along the way, and we'll try to catch them as we go, but also we'll leave some time at the end to be able to answer those.
Also, so if you see us looking off screen, try and see
we're reading your questions, right? Yeah, we're here in the Keystone Financial Studios, so we do have fancy technology.
It's fun being in here. So this will be a pretty good update, I think. Some good information today. Might be surprising at some points.
Could be.
Find out. We'll have to find out. Very good. So everybody's coming in. We got a good crew today.
We do.
Fabulous. All right, and that is the top of the hour.
Are we recording?
We are.
Excellent.
We are ready.
Welcome everyone to the Keystone Financial Studios. We are here live, myself and Jeremy Busch. We are your certified financial planners, and you can see we've got a bunch of other letters after our names too, which mean other important things. But the CFP is the gold standard in our industry. That's the one you want to look for when it comes to looking for a financial planner, advisor. That's the one that tells you that we're board certified. It actually means we're board certified. We've had to go through several years of education and certification requirements. There's also ethical considerations to keep up with. They do background checks, all that stuff. So it definitely is the gold standard when it comes to the financial planning industry. But glad you're here though. But today we're going to be giving the halftime presentation. This is something that we've done every year since 2011, I believe, was the first year we gave a halftime presentation. And of course, these days we sometimes we'll do these live, sometimes we'll have them at an event location, but we always do it by webinar version because we have clients all over the country now. It's not just in Colorado. We've got clients literally from New York City to Seattle to Southern California to the tip of Florida. So literally every place except for Hawaii, which it will be interesting. If any of you have friends in Hawaii that you'd like to refer to us, we would love to work with them, which means we would also have to visit them, right?
Absolutely.
Yeah. So
Yeah,
anyway,
like that
I'm
idea.
sure that one will come soon. But anyway, glad you're here. This is Halftime 2023. We're going to talk about a few different things today. One of those is going to be the economy. Certainly, there's no lack of information out there. I think that's why we still have jobs, actually, because there's too much information out there. And a lot of it contradicts itself. And so we'll give you our opinion. We'll tell you what we think and kind of where we are so far for the year. Also, what the experts are saying as well. Then Mr. Busch will be getting into the financial markets, talking about where we are so far for the year. Surprising, again, in a good way. Sometimes surprises are good. And then we'll also be talking about what may be ahead. But before we do that, the attorneys have some things that they'd like you to look at right now. So disclosures, more or less what it says is that these are just our opinions. And we don't know what's going to happen in the future. And it should be comforting to all of you that nobody else does either.
Nobody knows.
These are just our opinions and in our research and looking at what the experts are saying. So glad you're here. But before we dig into the meat of the presentation today, we've got a little bit of warm up, right? That Mr. Busch is going to do.
Absolutely. The grand world of social media. So everybody wants to be an influencer, right? I'm sure all of you out there listening want to be an influencer. No, but the funny thing is that not only people can be influencers, but also animals. That's the thing.
It's true.
Animals being influencers. So question one, what breed of dog is most likely to become an influencer? Is it a specific breed like a corgi or a husky or a retriever or mixed breed pups? Any takers? I honestly had no clue on any of these. I just had to kind of click through them a bit. But overall, the answer is mixed breed pups. You actually have one of these.
We have a golden doodle.
Yeah.
So, and in fact, he doesn't look that much different than this golden
Right,
doodle. When he was a puppy, at least that's what he kind of looked like. But yeah, that's a big thing these days.
He could be an influencer.
Yeah, mixing poodles with everything, right? I think that's kind of
That
what's
is a
happening
popular
right
one.
now. It is.
And golden retrievers. And
yeah, absolutely.
Apparently. But it's not limited to dogs either, of course. There are cat influencers. In fact,
we do have a cat now too.
Oh, there you go. That's right.
I just got one a month ago. Yeah.
There is a wealthy cat out there. Nala the cat. I've never heard of her. I don't know if you have.
I had not.
Nala the cat.
I'm gonna have to ask my teenagers. Maybe they
Yeah.
have. I'm sure they probably have.
Maybe they've known her. But so she is wealthy. The question is, how wealthy is she? She gets paid in catnip and had to rent an extra large storage unit for it. I can see all like the neighborhood cats just hanging around her storage unit for that. She is in the top 1% of wealthy Americans. She receives 10 pounds of yellowfin tuna loin each week. Can a cat even eat 10 pounds of?
That's what I thought. That would be a big cat really quick. Yeah.
Or she's richer than Elon Musk. And the answer is, this is actually kind of sad in my opinion.
Yeah.
This cat is among the top 1% of wealthy Americans, and it's a cat.
Yeah.
I wonder if she has estate planning.
I don't know, but if I could even earn a fraction of that with our cat,
right?
That would be fantastic. We need to get on that.
Well, if you got things like Nala the cat making $100 million, how many pet owners want, and maybe that would change depending on if they saw those stats or not. But
it might be.
What percentage of pet owners want to make their pets stars,
right?
On social media. So 25 all the way up to 95. The answer is only 25% of people.
Yeah.
So really,
when I saw that question originally, like, I don't think so.
Do you know how much work that would have?
That would be a lot of work.
Like
that would
constantly.
That would be a full-time job.
Pictures and videos of your animal.
It would.
That's all you did. And one more for the day. So name that influencer. I also did not know this one. This pet situation isn't like most influencer dogs. He's spending off paparazzi on Hollywood Boulevard, pool parties, horde of bikini-clad models getting chin scratches from rappers, backstage at music festivals. Who is this dog? Dylan the Wonder Wolf, Loki the Wolf Dog, Swaggy Wolf Dog. I like the name Volric for some reason. Dude, there should be a movie on that. I don't know.
It's a cool sounding name,
right? Volric.
Yeah.
But regardless, the answer is Swaggy Wolf Dog. And honestly, I had to read this in the notes. This is not actually Swaggy Wolf Dog.
No.
His face is
This
copyrighted.
is the royalty-free whoop dog, right?
So this technically is not Swaggy Wolf Dog. It's got 7.5 million followers though. So, but still doesn't outpace Nova the cat for earning income.
Yeah, that's amazing. I'm sure they'll work on it.
Right?
Yeah.
So now that you are up to date on all of your
and cats can live a long time too.
can.
So
Longer
yeah,
than
that
dogs,
think about how much that cat could earn in its lifetime. Pretty amazing.
Absolutely.
Hopefully they've got good insurance on it, right?
I'm sure they do.
Yeah.
I'm sure they do.
Yeah. So we're going to talk about the economy now, on to more pressing matters. And you can see the aircraft here. We like to use airplane metaphors, not because either one of us are pilots, because we're not, but sometimes we feel like we're financial pilots, right? Because our job oftentimes is making sure financially, at least, that our clients are getting to where they want to be, and that they get there safely, they get there as comfortably as possible. I mean, that certainly is a factor. I've known actually friends with a number of airline pilots, and I've talked to them about turbulence and various things. Hey, what about when this happens? And turbulence, which certainly the last few years have been turbulent, it doesn't bother them a bit. The pilots are so used to it, it doesn't bother them a bit, but it does to the extent that they know that the people in the back of the plane are experiencing that, and sometimes have a lot of anxiety, depending on how much flying experience they've had, that sort of thing. So we use that metaphor a lot because oftentimes the economy and the market, a lot of it is turbulent. There's not a smooth ride. Oftentimes there's not a smooth ride that we're experiencing. So again, that's why we have jobs, because things change constantly, and certainly turbulence is part of it. So the economy, interestingly enough, we've I think this is the longest predicted recession that we've ever had, right? If you've been paying attention to the news, the financial media, it seems like all the time over the last year and a half, at least, that, hey, there's a recession coming, and it just hasn't come. That doesn't mean that it won't get here. But if you look at the chart here, going back to 2020, and it was interesting. I remember distinctly because we gave our forecast presentation in January of 2020. And that was right about the time that the term, even, right, of the pandemic, right? What was the pandemic called now? It's been so long ago, right? The coronavirus, right? Yeah,
COVID.
Yeah, exactly. Yeah, COVID. So, how quickly we've moved on to other things, but the entire economy shut down, really globally. It wasn't just in the U.S. The entire economy shut down, and so you can see we had a bad recession. It was a very sharp recession, and then very quickly things started bouncing back. Because the Fed and Congress, at least in this country, responded in a really big way, in the trillions of dollars way, which we'll get into inflation later. That's a whole other issue. But ever since then, we saw this big drop, this big bounce back, and we've seen kind of a little bit of up and down over the last few years, but no recession. There hasn't technically been a recession based off of the powers that be. They've not designated any of this to be an actual recession. So it's pretty interesting. The Fed raised rates, and the Fed completely dropped the ball on this, and they've admitted that actually that they completely dropped the ball, and that there's trillions of dollars. Last count, it was $8 trillion plus that was injected during that time period by Congress and by the Fed in various means, right, of doing them. So they injected a ton of money into the economy, and at the same time, supply was being contracted. You might remember supply chain issues. You couldn't get a vehicle. All the lots were empty at dealers and so forth. So people had money, but there wasn't any place to spend it. And so, of course, you've got too many dollars chasing too few goods. That caused a big inflation problem. And the Fed was very, very slow to respond to that. You can see that in the chart from 2020, 2021, no rate increases. They kept rates at zero. So they lowered rates to zero back in spring of 2020, again, to be very aggressive to try to keep us going into not just a recession, but into an actual downright depression. And that very well could have happened. So that was the right way to respond, certainly. But then they waited and waited and waited. And do you remember when they used to call inflation transitory? You might remember that word used, that inflation is spiking, but it's transitory. It was not transitory. And in fact, they recognized that later on. Huge rate increases. In 2023, we saw rates go basically from zero up to 5.25 to 5.5. Now we just saw a rate increase yesterday. So now that was 11 rate hikes in 15 months. very aggressive because they were trying to make up for lost time. They really should have started doing it incrementally earlier on, and they admit that now that they waited too long to address the problem. Now inflation actually has responded and has been coming down, and you can see this is actually a bar chart showing the different sectors of the economy. Back in 2022 and 2021, really, that was when we were feeling the majority of the inflation pressure, the inflation pain in our pocketbooks, right? As far as our money not going as far, not buying as much stuff. So you can see the big jumps that we had seen earlier on in energy, that's really abated. Energy prices in general have dropped way off now. So that's had the biggest impact, as well as food supply chains have gotten better there. So some of those things have slowed way down, but inflation is still there. It never goes away. Really, there's only been one time period back in the 1930s that you had any kind of prolonged deflation. And that's not a good thing either. You don't want deflation. That means your economy is actually going backwards in a really bad way. But when inflation gets out of control, and the reason why the Fed rate hikes rates is because they're trying to slow things down. They're trying to keep inflation from getting out of control. It's not exactly a precision instrument. They start hiking rates, and you can see on the chart here, what it's really tracking is the blue number is rates at zero, them raising rates. And then at the same time, looking at the 30-year mortgage rate, looking at the car loans, looking at the prime rate that banks lend to each other. It wasn't exactly in lockstep as far as those things happening. In fact, the Fed is still raising rates right now, and mortgage rates have actually started coming down. So it doesn't exactly move in lockstep. And again, the whole reason, the quote here you can see from BlackRock, the whole reason the Fed hikes rates to begin with is to slow a booming economy and prevent overheating. Against this prosperous backdrop, while the Fed is hiking, businesses and consumers tend to feel confident spending, and they certainly are. If you go to the airport, you go any place right now, consumers are out there, they're spending money, they're on the roads. So you can see that it's very, very difficult to make the argument that it certainly doesn't look like a recession because people have money in their pockets, they've got jobs, and they're certainly spending the money right now. The bond market also does not always move in tandem with the Fed. Last year was a terrible year for the bond market. In fact, I think we told you last time that it was the worst bond market ever. We did some additional research on this, and we found that the last time that it was this bad was bad one other time, and that was when George Washington was president. That was a worse bond market year.
Back to the beginning.
Yeah, yeah. So it was a while ago. It wasn't forever, like we said, but it was a while back that you'd have to go. In other words, if you're more heavily weighted in bonds in your portfolio, and most of our clients have bonds, they have that as part of their allocation. It was very unusual that you don't see that kind of a drop in bond prices with the spike in the Fed rate. They really kind of rocked the economy by being so aggressive because they were trying to play catch up from what they had mistakenly kept rates low before. So why is the Fed pausing, or why have they slowed down the rate increases? Part of that has been because we had 3 banks actually collapse earlier this year. In fact, there was fear for a while that there was actually going to be an all-out financial crisis, with people being concerned about, especially smaller banks, regional banks, credit unions, that there was concern about uninsured deposits, and a lot of consumers, were shifting money. They were shifting money even into the big banks that were perceived as too big to fail. So they were actually, looking back now, there were only 3 banks that had made individual bad decisions along the way. They made some big blunders in their risk management, of course, now we know, but it did not spread to the rest of the banking system, thankfully. But that was a thing. Certainly a few months ago, that was an important thing that was being watched. The Fed basically stepped in. They provided a lot of liquidity into the banking system, and that kind of quelled the fears that were there. Also, because of that, bank lending standards tightened up. So loans are harder to come by. Things have been kind of loosening up there for a while, but loans are, again, a little bit harder to come by. They're not making as many risky loans, maybe with questionable credit situations at this point. So how will the economy land? We've talked about soft landings, hard landings, sticking with our airplane or airline metaphor. What are we looking at here? Soft landing or hard landing? So looking at our descriptions here, the soft landing, economic growth slows, then picks up. Inflation drops. We won't have a recession, and then economic growth may be steady or pick up after that, and that the Fed would hold steady or actually lower rates. That's actually what we're going with right now. We still believe that it's going to be a soft landing at this point. Evidence that continues to come in. In fact, this morning they just reported GDP numbers were better than expected, and the numbers we saw from inflation a few weeks ago were actually better than expected as well. Inflation is dropping in a pretty meaningful way. It's getting harder and harder to make the case for a hard landing at this point.
Which, if you go back to our, I think this was one point that we made in the forecast event, is we were kind of thinking opposite on that one.
Right.
Because
Absolutely.
soft landings have historically been very difficult to do, right?
They have been, and the Fed, in the end, I mean, they may get it right.
Yeah,
They certainly kind of blundered along the way, but I think they're certainly committed to not having inflation be out of control. That's very clear at this point. They've gotten very aggressive. They're not going to let inflation go back to double digits again, like we were seeing last year. So soft landing, hard landing, that would really be making the case for economic growth contracting in a major way. Inflation dropping off of a cliff, if not deflation, in an outright recession. And certainly a big evidence of that will be consumers pulling way back on spending, largely because they'd lost jobs. So right now we're still at a 3.5% unemployment rate. That's one thing that we're really watching closely is, are there big increases in layoffs, people leaving the workforce? And we're not seeing that right now. Unemployment is staying very steady at this point. There's pockets. It's not to say that people don't lose jobs, but that's structurally, that's kind of part of the economy. So there's always some company that's laying people off and some other company that's hiring. But overall, when we talk to business owners, that's the number one thing that they complain about. Managers and business owners are complaining about there's not enough workers. There's not enough people to do the jobs that are open right now. So faster wage growth, we continue to see that because of the low unemployment rate. We've had to get very competitive as employers, right, as far as making sure we've got good benefits and pay and so forth. But there's been fewer new jobs. So it's a little bit of a mixed bag, of course, as always. There's always a bit of a mixed bag when it comes to economic data. But we believe right now we're still making the case for the soft landing looking like the better bet right now. So manufacturing, again, a mixed bag of information. Manufacturing is pulled back globally. We're seeing some pullback, but at the same time, we're seeing the service economy pick up. So it may be that those are just canceling each other out right now. Another thing I wanted to mention here too is housing. A lot of people ask about that. Housing, we certainly saw a big pullback, although a lot of you say, wait a second, we just saw these big property tax increases this last year. Now, remember that you're always a year behind. The county, when they're doing their assessments and getting their guesses on what your house might be worth, they're always looking a year behind. So it'll be interesting to see what happens this next year. We might see some declines in prices. We might see a little bit of relief there. But overall, Barron's makes the case here for our recovery in the housing market. A couple different things here. Number one, you've got a limited supply. You've got homeowners that basically don't want to move because they've got a 2.5–3% rate on their mortgage. Nobody wants to give that up when they're looking at going out and getting a 7% mortgage. That's a lot bigger payment or a lot less house that you can buy. So a lot of people are just sitting tight at this point. They're not moving around. But at the same time, you've got millennials that are wanting to buy houses. So a lot of them that haven't gotten into homes. And the millennials actually by population is actually bigger. That generation is actually bigger than the baby boom. So you've got a big undersupply right now. That's one reason why I think we're going to see the prices pick back up. There's some stability there and not enough houses being built. Some of that was because of supply chains, cost of building materials before. But yeah, that continues to be a thing. It'll be interesting to see what ends up happening in the next few years. But I think there's a good reason to believe real estate's going to pick back up. And then another thing is, what if we don't have a soft landing or a hard landing? What if we just kind of putz along and are in stagflation? We talked about that in the forecast. That would mean that we have slow economic growth, but no recession. Inflation kind of spikes, takes back off again. Steady consumer demand, which is a good thing. We've seen that. And then that rates would stay higher, move higher. That's possible. We saw that in the 1970s. Actually, that was largely what stagflation was, that decade, just kind of going back and forth, where the economy wasn't always in an outright recession, but it kind of felt like one because inflation was so high. And really the Fed, I think, is committed to nipping it in this case. I think they probably would go for a hard landing, as opposed to letting inflation take off again.
I think if they're past, what they've done over the last 6 months is any indication.
Yeah.
They're not the type of Fed to stick by and run for stagflation.
No,
they'd be over aggressive and nail it to the ground first.
Yeah. Yep, and the chairman's actually mentioned that he wants to be seen as a Paul Volcker type
Mhm.
character. They kind of came in and killed inflation in the early '80s. At the same time, he killed the economy. So it's kind of like cancer. Inflation's kind of like cancer, in that if you've got cancer, you're probably going to have chemotherapy, radiation, and certainly that can kill cancer, but it can kill the good stuff for a while too. And so that's what we saw, is that huge spikes in the unemployment rate. We're hoping that stagflation is not a thing, and we think it's pretty unlikely that scenario is going to play out in this case.
Absolutely. So financial markets, where are we? So as of today, really what we saw last year was obviously a pretty rough year. Everything's bottomed out October 12th of 2022. And since then, technically we are in a bull market, which is basically just 20% up from where that low was, right? And
Absolutely.
but what you can see how we did that was a pretty volatile ride.
Yeah, extreme
And
volatility
I think
last
we've
year.
all felt that. So
Yeah.
you'd have big swings up and down the whole way, but over time, it has been a fairly steady climb, right? So we are technically in a bull market right now. What does that mean kind of moving forward? If we go towards the history of it, so if we look at the last 13 times that this has happened, basically over just the last 13 times that we've climbed out of it, we see a couple things here. So 10 of the 13 times that was the low, and the next 6 months after that were good months, right? So we had continued increases, continued growth to new highs. The only times that didn't happen, the 3 times that missed the bucket, well, we can kind of see them here, right? 2001,
Yep.
2002. That's
Many of you were invested at the time, and you might remember that 2000, 2001, 2002, 3 years in a row, the stock market was down.
absolutely. So those
Just
are
kind of
some,
unheard of. I mean,
yeah,
that you'd have that long, but it happened though.
it happened. It happened. And that's always that kind of one of those outliers on any financial data,
Right.
it seems, that we always talk about, right?
Yeah.
And then of course, the next one, or the last one that had this, was 2008. Right.
Yeah,
So
financial crisis.
some financial crisis, some systematic stuff happening there. And then what we can see is basically since then, just continued growth. We had a long run, right, on bull market, for a long time. The thing that makes this one a little bit different here is that the trading days to a new bull market. So 164 days since October 12th, 2022 to get us technically into that 20% up.
Yeah.
And I think that previous slide kind of showed that, right? Some pretty big volatility, big spikes up, big spikes down. It almost felt like for that time period that we were taking 2 steps forward, 1 step back.
Yeah.
Right.
Absolutely.
And during that time, it kind of makes sense too, right? Because we had banking stuff that was happening, those 3 banks.
Yeah.
That raised a lot of uncertainty. What are we doing? The Fed continuing to raise interest rates and nobody really knowing, are they nearing the end? Are they, a lot of things happening. But if history kind of gives us a good push here, I think the numbers are on our side from where this is. Was that a real low? Are we going to hit a new low? Really, from the data we're seeing, it doesn't really look like it at this point. So the 6 months, next 6 months actually look fairly decent.
Yeah. So it'll be interesting to see what ends up happening. Of course, there could be some outlier, and that's what we saw back in 2001. 2000, the market was down, .com crash, bubble, and so forth. There are a lot of things that were kind of happening there. But then in 2001, you had 9/11. In 2002, you had the financial, kind of crisis with accounting firms and, cooking the books, Enron, WorldCom. So you had several years of just really bad stuff happening. And that's not to say that bad stuff, there could be bad stuff out there that we don't know. It may hit, it may not. So that's always one asterisk we want to throw in there. But the odds, we kind of looking at the odds,
Right.
the odds are pretty darn good, actually, that we're going to see this continue on, that this is not a flash in the pan.
Yeah, it's always the bus you don't see that kills you, right?
True.
Again, kind of some more data behind it, if we look historically, is that a strong start to the year for the first 6 months usually means a pretty darn good next 6 months, right? As we go. So on average, about an additional 71% upon whatever our gain was. And so first 6 months, 5% on average over the years. We can see how it kind of helps out. If we're technically, I think for 6 months, we're actually in that 10 to 15% column right there.
Yeah.
So not too shabby. I think honestly, looking back to forecast where we are now, I think this is probably better than expected.
Yeah, absolutely.
Of what we were expecting.
Yeah, definitely. Yeah, and really the naysayers, we thought this would actually be a good year, but a lot of the naysayers were saying that market's going to crash, that we're going to be in a terrible recession. That just hasn't materialized. I think the evidence, it just continues to point more and more that that's not going to happen. There could be a mild recession, but it's probably not going to happen in the next 6 months. Certainly the consumer is so strong right now, unemployment is so low. It would almost take, knock on wood, it would almost take like a pandemic type thing, I think, to throw things off that badly.
Yeah, some big outside factor.
Yeah.
Absolutely. So one of the things that we've, you might have heard in the first 6 months too, is that a lot of the naysayers were saying, well, yeah, there's this growth, but it's only a few companies that are really leading the way.
Yeah.
And most of those companies were tech companies.
Yeah.
What we have found is that, yeah, that's how it started. There was a few companies that were leading the way, and largely by, AI and tech stuff. But really that's broadened since then. So they might have been leading the way, and that's not really unheard of, right? Tech usually tends to lead the way in things like this, but other companies kind of catch up. And so if we take tech out of the S&P 500 and see where everything's at, your overall valuation on the S&P 500 is actually fairly average right now.
Yeah.
So it doesn't mean that it's overvalued, undervalued, et cetera. It's actually doing pretty healthy.
Yep. I think we're right at the 20-year average right now. If you pull out tech, and you think about technology in general, the tech sector always tends to kind of run expensive. It tends to be, it's kind of the growth sector. It tends to run more expensive historically. So not to say that it couldn't pull back, but I think that also makes the case for diversification, that you want to make sure you don't have all your money in that one sector. And that's the temptation. Oftentimes, people get tempted to jump around. And last year, the only sector that went up in the S&P 500 was energy. Everything else was down. So some people could have gotten tempted. We didn't, of course, but you could have been tempted to say, well, why don't we just put all of our money in energy stocks? All this other stuff is going down in value. Well, now it's just the opposite, right? Energy stocks are actually dropping year to date, and you've got your tech companies taking off. So that's why you want to stay diversified, why you want to keep your eggs in different baskets. Don't put everything in one area.
Absolutely. And so this one kind of hits home for both of us, I think. Josh has a son going. He's going to be a freshman this next year at CSU.
Yes.
My oldest, she's a senior this year. So we're doing the college thing. But oh no, my robo-dog ate my AI written essay. That could be a thing in the future, right?
I think it is. I don't know about the robo-dog. I'm sure that's coming. But yeah, you can certainly have AI write your essay.
Right? Yeah, I think teachers, I would not want to be a teacher right now.
No.
Battle that.
No. You're going to have to get creative to figure out how to make sure that somebody's still learning, right?
Absolutely. Yeah. So really, and like Josh was just saying, so the things that have done well through the first 6 months, information technology, communications, and then on the far right, energy, consumer discretion, or that's utilities. So if we looked at this last year, this would have been flipped. Completely. Right.
Exactly.
So again, not putting all our eggs in one basket. We're going to stay diversified. This is the exact reason why we do that. Because 6 months ago, if you would have said, hey, what's going to be doing great in the next 6 months? I don't think either one of us probably would have picked information technology.
Probably not.
I don't know many people who would have.
Especially with all the predictions of recession, because the tech sector and growth stocks in general do terribly. If you're actually in a recession, that actually kind of leads the way with the losses. You go back and look back to 2000, 2001, 2002, the tech sector was down way over 50%. I think it was like 70% at one point. And certainly there are a lot of dot-coms that just disappeared during the time frame.
Absolutely. So really, mixed bag of things, right? And so a lot of what we have to deal with, I think, on a daily basis is market perception. And this is where statistics can get kind of crazy. So this slide and the next one. So technically, first quarter earnings and second quarter, now that we know this, have declined. And so they do that a year over year thing. But they were still better than expected. Right. And so
probably because expectations were low.
Exactly.
So with predictions of recession.
So when expectations are low, you can still have, decline in earnings, but that can still be a good thing. So if we really look at it, yes, 78% of the S&P reported better than expected earnings. So much of the market relies on sentiment, right? It relies on trying to protect what's happening next. It tries to price in what it expects is going to happen. And then when something is better than expected, the market says, yay, that's great. It's still not very good, but yay, it's great. So it's and this is the kind of stuff that we get to deal with on a daily basis, right? That makes our job interesting. But overall, what we're seeing is some pretty good broad strokes. So 8 of 11 sectors year over year revenue growth. That's fantastic. And then 11.5% of blended net profit in the S&P 500.
Yep. So not terrible. Not terrible by any means. Yeah, and it is the stock market in and of itself, and the markets in general are kind of a prediction mechanism. So always keep that in mind, right? Is that if you see the stock price of a particular stock today, what that really reflects is earnings expectations over the next 6, 12, 18 months. So that's why the stock market is so difficult to predict, because it in and of itself is kind of a prediction mechanism. So every millisecond, in other words, when things are trading, that's why things are trading the way they are, is because it's everybody on the planet that's trying to outguess and kind of predict where things are going in the future.
And why the market and the economy do not always move.
Yes, and they do not. Absolutely.
Right. Yeah. So the one thing you might be hearing some of, which can be confusing, is money supply is contracting. So Josh had mentioned we were just at a thing in the mountains with a lot of smart people, right? And
Fidelity, Schwab, BlackRock, all the big kind of dogs flew in for this, which was great. Good learning opportunity.
Good learning opportunity. So this is one where, depending on where you get your news from, you might see this. And this can be one of those red flags that they wave. And they say the money supply is contracting. Well, what does that mean? Really, your money supply is just basically the cash that you have. And so there's two levels of it. There's just stuff you have in your bank right now, stuff you have in your pocket, anything that you can sell within a day and basically go spend, right? And so what they'll say to kind of raise the alarm is that, oh no, the money supply is contracting. And oh no, this happened 4 times over the last 150 years, and each time there was a depression that happened after it.
Right.
So that's the stats saying, oh no, we need to raise a little bit of fear. But when we look at this and when we listen to these smarter than us people out there who are kind of doing this, tracking this stuff, is the fact that the money supply had never been as high as it currently was over the last year.
It's true.
And a lot of that we've kind of we touched on, right, is all the stimulus money that went out.
$8 trillion.
So much of that. And we had created how much? 25% of our overall money supply in about 2 years' time. And so obviously it's going to be really high. And so that's something that's been needing to come back under control a little bit more.
Really, we're more back to average.
Yeah, exactly. Right. So we're coming back to average. So yes, technically money supply is contracting, but that in and of itself does not necessarily make this a bad thing.
No, but I think you have to look at all these things, right? All these data points, you have to look in the context of everything else, which is what's interesting, and why even the smartest people, Federal Reserve, you would think they have all the information, right? And it would be able to make all the right decisions, but they screwed up, right? They certainly screwed up when it came to calling inflation and how bad that was going to get.
Absolutely. But the things to keep in mind, consumer spending is still strong. So still talking about that money supply, of course, all that money that was thrown out there, all that money that was created an excess savings. And so, yes, there is still a ton of excess savings out there. Some of that has been spent down, which I think is what we're looking at is, yes, people are still spending down that money, but we've said it before, we'll say it again, 70% of our economy is people like you and me spending money. And so as long as that kind of continues, we're going to continue to see this. So that's, another thing that the Fed is taking into account. People are still spending money, which is why I think they're still on the let's raise bandwagon.
Yeah, and even though inflation has come down dramatically from where, by over half from what it had been before, historically, we're still above the long-term average by a bit. So, yeah, that's what they're going to continue watching, is making sure that it doesn't get back out of control. It doesn't kind of spike again. That's the worst. And that's kind of what happened back in the 70s as the Fed started tightening, they let off the gas, and then, another big spike in inflation. That's really what they're trying to prevent right now.
Absolutely. So then when we look at CNBC poll, really they just go out and they ask a bunch of Wall Street bigwigs,
Yep.
right? And they say, what do you guys think? What kind of market are we in right here? We're always going to have a chunk of people that are always going to say it's bear. Right.
Yeah. They call them perma bears.
You're never going to change their mind. But really, when it comes down to it, the vast majority of people are really saying that, yep, we're in a bull market. It looks like it's got some room to run.
Yeah. Yeah, absolutely. So the bear market rally folks, in other words, ones that are saying that, basically don't think this is real. They think that we're going to see a big pullback again, and we'll actually retest those lows that we saw last year. We certainly hope that doesn't happen. But again, everything that we're seeing, kind of looking at all the evidence, kind of points to right now, unless it was some kind of a shock event or something like that, that looks pretty unlikely right now.
And those ones are the ones that have been screaming recession for probably the last 18 months.
Right. Yep. And in the end, they might be right, especially if the Fed continues raising rates and they go too far. And historically they have. If we look at that's why a soft landing is so difficult, because oftentimes they end up going too far and it ends up causing a recession, and sometimes a bad recession. So,
absolutely.
Yeah.
So obviously the last year was very challenging for bonds. I've said it in a number of meetings. I know I've heard Josh say it as well, but really just kind of the bond teeter-totter. So on one side of the bond, you have the price of the bond. On the other side, you have the interest rate. When they raise rates like they've been doing, that price of the bond is going to go down. That made the last, I would say, year and a half fairly difficult, just because when you rely on bonds to be that downside protection,
it's supposed to be your turbulence buffer,
right? Yeah, that's the ballast of the ship. And when those happen, that makes it rough. But really what that's done is that's led us over the last 10 years, bonds have not been super great things to have, in large part because rates were so low. But now what we see is we've weathered that storm. We've gone through that raising, and they might not be done raising right now, but we're seeing rates on CDs and T-bills, virtually risk-free investments that we haven't seen in over 10 years. And so really, I think looking forward, what that means is that bonds should really act like bonds, like we'd expect them to act over the next,
probably no big price declines, in other words, like we saw last year.
Exactly. And then eventually what will happen is the Fed will pick down on rates. They will drop rates. And when that happens, those bond prices are going to pop back up. And so again, the outlook for the foreseeable future anyway is that bonds should be reacting as we'd expect bonds to do, not like they've done in the past year or so.
Yeah, absolutely. So probably just your interest, basically. That's kind of the expectation, is you're going to be earning your interest on your fixed income securities. But sooner or later, there will be a point, it may be next year, maybe it'll even be the following year, that the Fed starts lowering rates. That actually will, again, a teeter-totter effect. You might see some price appreciation in your bonds. So that's two ways you can make or lose money, in other words, in fixed income securities.
Absolutely.
So just be aware of that.
Yep. And then, of course, the yield curve, that one's still in the media as well. You always hear that if you listen to any financial news. Yield curve remains inverted. Really, all that means is that why would you tie your funds up in a 30-year bond or whatever for 2% when you can buy a 3-month or a 6-month for 5%? Right.
Doesn't make sense.
Absolutely. And so the yield curve's been inverted for quite a while. Some statistic people will come on here and they'll be like, well, that usually means that we're headed towards a recession. And so that's been one of those data points that those bears have been saying for the past 18
it's
months.
an imperfect, it doesn't always happen, but sometimes.
It is an indicator, it is correlated, but it's not a for sure. But really all that means is that, for the time being anyway, 3 to 6 month treasuries and CDs are pretty fantastic. And so you can make, 5+% on those over the very short term. So take advantage while you can. I mean, we certainly are with a lot of clients.
Yep, for sure.
But overall, when we look at the first half of this year, so S&P 500, that's basically the US, Q2 8.7, year to date 16.9. Been a great year, better than expected. I think that's really what this entire slide says. It just have a big better than expected written across that chart. The ACWI, the second one down, that's basically the world, where the rest of the world is. EAFE, that's developed Europe, Japan, developed countries. Again, all positive. Even emerging markets, so Africa, Southeast Asia, they're actually positive as well. So this really isn't just one thing. It isn't just America leading the charge or anything. This is actually worldwide. And so while we're thinking about this as well, is we have our Fed making decisions, but there's also like the European Central Bank.
There are other Fed,
right?
Yes.
Yeah, everybody has their Fed, and they're all doing different things as well. So they're all kind of following suit. Maybe one reason why our numbers are a little bit higher than the world average is because our Fed actually started a little bit sooner and has been a lot more aggressive than, say, the European Central Bank. So they're still following suit, moving in the same direction. They're just not quite as quick to go about it. But overall, really what we're looking at is just kind of better than expected in the financial markets for the year.
Yeah, very good.
Yeah.
Diversified investor, probably happy right now. For an undiversified investor, might be very happy or very unhappy. As you can see from the chart, if you had put all your money, into the mid-cap value, we'd never recommend somebody did that, but in the mid-cap value style box, you'd be barely made anything year to date. So that's the case for diversification. It's not as exciting, certainly, if chasing tech stocks or AI stocks or something like that, but there's certainly a downside to it as well.
Absolutely.
So what may be ahead? Now we'll take a look at a few different things here. This is always an interesting part of the presentation because we're talking about the future, and that's murky as always. But when you look at technology, it's always been the driver of our economy. It's been the driver of productivity. And so a few things that are coming down the pike, and there's a lot more than this certainly, but just a few things to kind of pique your interest of why we're pretty optimistic long-term of economic growth, especially in this country, but globally as well. Immortality for sale, artificial intelligence. They're talking about how AI will be able to do some pretty crazy things. For example, inject us with nanobots. Say if we figure out that we've got cancer, they'll actually be able to inject us with nanobots that are smart enough to find the cancer and actually change the DNA of the cell from cancerous to non-cancerous, which sounds like wacko science fiction, but they're actually saying, no, we're actually pretty close to doing this right now.
Right. There's been movies written about it
Oh,
already.
gosh. I mean, you just think about just that one thing, or being able to change, somebody who's got Alzheimer's or Parkinson's, something like that. You just imagine how many 100-year plus people are going to be running around in the future, and you could be quite healthy too, right? So lots of technologies coming there. Digital olfaction, that would be interesting. That tech companies are saying that they're eventually going to be able to transmit smells, through our devices, which
digital smells.
Yeah, that sounds crazy.
Wrapping my brain around that one.
Yeah. Super app domination, the fact that we'll become so loyal to our apps, they'll be so good, again, probably powered by AI. They'll know us so well. We'll be even more dependent on them than we already are. And then finally, virtual power plants. Right now, our grid is pretty antiquated, and in the future, they're saying that actually AI will be able to be smart enough to be able to move energy around between the different sources and be a lot more efficient. There's a lot of waste right now that ends up happening. A lot of inefficiency. Growth projections overall, we're expecting that we're going to continue to see growth. It may not be super fast growth in all parts of the world, but prediction is that for this year, global GDP at 2.8%, next year 3%, so pick up a little bit. It just so happens that's about the historical average over the last 100 years. That's about the average is about 3% per year. Globally. So again, cases is still being made that there may be slower growth than we've been experiencing, but probably not a global recession. National debt, we won't spend a ton of time here though, but that's one concern. It's one thing that comes up is that we've got $31 trillion worth of debt right now. A bunch of that, we had a 35% increase in that debt level from 2020 through 2022. So again, we talked about the inflation problem. So much money got pumped into the economy, and couldn't that be a problem as far as debt levels? So it's all relative to how much debt that you've got based on your GDP. And it actually has been, we're seeing some improvement here, but when you kind of look at all the deficit spending, you see back in the 90s in our chart here, actually look back in the 90s, we actually had a slight period of time where there was a surplus, but generally over the last 100 years or so, we've either been break even or in a deficit. It's just that the accumulation of all the annual deficits is equal $31 trillion over the last few years. Nothing to sneeze at. Long term, if that continued, it certainly could hamper economic growth. Something that we're watching, but probably not something that we're seeing on the doorstep as far as a big problem. The national debt, very quickly, publicly held debt, that would just be people owning treasuries, governments owning treasuries. Part of it is also intragovernmental debt, which would be Social Security. It would be Medicare kind of holding, trust funds holding treasury securities. So it's kind of a complicated issue, but that's what makes up that $31 trillion worth of debt. Believe it or not, most of the world, and this is part of the concern about the US, most of the world actually saw a decline in debt. 65% of countries, including developed countries as well, actually saw a decline in their debt levels. We did not. We actually took on a lot more debt. Of course, we could get into a big debate about whether that's good or bad, but ultimately we kind of went the opposite direction of most of the world. That also could mean that we're a bit less competitive in the future. One reason why we want to stay globally diversified, not just have US investments, we want to have things outside the US as well. And overall economic growth and inflation have helped to reduce US debt, though incrementally, I mean, just a little bit, in other words, over the last year or so, because tax receipts have been so good. Actually, a lot more money has gotten kind of pumped into the government. So that's kind of helped out. The economy growing, in other words, can help you grow out of debt problems to an extent. But overall, it may be something that we need to grapple with over the next year or so.
And that's another one of those things that's better than expected, I think, is that Q1 GDP was 2%, Q2 was 2.4.
Yeah.
It just came back.
Yeah.
So better than they were expecting.
Yeah, better than expected. So that's a good thing. Sentiment, we talked about that before. This is the American Association of Individual Investors. Don't get this confused with the experts. This is basically individual traders, people who individually trade their investments without the help of professionals. And shameless plug, but they've actually done studies on it. Shameless plug is that the average individual investor doesn't do very well. They tend to trade on their emotions, and you can kind of see on the chart here, January 5th, only 20% of the AAII respondents, only 20% were bullish. Well, that was about the time that would have been really good to invest in stocks, right? Because you would have gotten all the gains so far this year. June 28th, 41% is over doubled, right? I mean, the people that are bullish now, that's after the market's gone up a bunch. So that kind of shows you people can get whipsawed by their emotions. People tend to be left to their own devices without professionals. In other words, people tend to get scared, and so they end up selling or they don't invest, and the opposite, right? So you want to make sure you buy low and sell high. That's the first rule of investing. The first rule of investing, Warren Buffett says, is don't lose money, actually. But we'll say the second rule of investing is buy low and sell high. Don't do the opposite. But that's the AAII, the average person that's an AAII person, they do the opposite. They end up trying to buy high, sell low. Makes no sense, but that's why their results have been so bad. So it's kind of a contrarian indicator, in other words.
Pushed by a lot of greed and fear of missing out.
Fear and greed, absolutely. So want to resist that. What the experts think, Stanley Druckenmiller, they haven't separated the wheat from the chaff yet, but I do believe, unlike crypto, that AI is real and it could be as transformative as the internet. Bill Gates actually said that recently. He was quoted that he believes that AI is the biggest game changer that he's seen since the early 1980s, even more so than the internet. So interesting, quote from somebody like that to say that. Ryan Dietrich recently said nearly every strategist and economist told us the same thing, that the economy was headed for a recession. Stocks were going to crash during the first half of the year. as General Patton told us, if everyone is thinking alike, then somebody isn't thinking. That's very wise, I think, why we want to look at some different opinions and don't just believe what the herd is telling us.
Right.
So the consumer remains extremely strong, employment solid, and housing is showing real signs of bottoming. We've been in the lonely camp that thought we would avoid a recession in 2023, and others are starting to come around to this realization. Stocks lead the economy. We talked about that. Stocks tend to look ahead, and we think they are indeed suggesting better economic times are coming. We believe that's true, especially in the long run. If you kind of look over, there could be turbulence in the short run, but we're not as concerned about turbulence. It's a factor, but we're more concerned about investors who are going to be invested with us for 5, 10, 20, 30 years. We want to make sure that we're positioned correctly. And then finally, Liz Ann Saunders with Schwab, one of our theses around this rolling recession is that best case scenario is not really soft landing in the traditional sense, but a continuation of the roll through such that at some point services might start to get hit. You're seeing some cracks there, or the labor market gets hit, that you've got offsetting stability or strength in other areas. So a little bit of a different take on it, but their take is actually that we'll continue to kind of roll up and down like we have, that there may be more of a stagflation type scenario. So certainly a lot of different people out there that are talking about this stuff, but very few actually experts at this point are saying that a hard landing is likely, at least in the next 6 months. So there's a lot to think about here. We've thrown a lot of information at you. And again, that's why we've got jobs. Well, we've got good job security because there's so much information out there.
So please take this opportunity. We got a couple more slides to show you just of us and how awesome we are. Just kidding. But take this opportunity to throw that in the Q&A. You find that at the bottom of your screen if you do have any questions. We have a few more minutes here where we'd be happy to take those questions. But as always, we have our services grid up on the screen, just kind of trying to, people ask us all the time, well, what is it that you do? What sets you apart? This is a very shareable thing as well. So if I have any friends that want to say, well, I want to recommend you guys, but I just don't know how to do it. This is something we can give you that you can show them and say, yep, they do this, this, and this as well. And it's also just not Josh and I, right? Right. We have a whole team of people that we have out here. So 8 of us currently across 3-4 different states. Absolutely.
Yeah. And our team is our biggest strength. The fact that it's not just an individual, and not to knock anybody, else. Right. But I mean, there are a lot of financial advisors or professionals that it really is just them. They don't have a team to back them up. The fact that that we're all serving you, we're all here every day to take care of you and your families, not only when things are going well, but obviously there's a lot of life stuff that happens too. People pass away, people get sick, people go through challenges, they might get laid off from their job. And of course, we're there for that as well as to celebrate when things are going well. So we certainly want to walk with you on the way. Comprehensive financial planning really is what we're all about. We look at your entire financial life, not just the investments. And really that's we talked a lot about the market and the economy, but a lot of these things like taxes and policy, and trying to figure out how to take care of kids, adult children that we're trying to benefit, maybe by doing gifting strategies, things like that, estate planning, lots of other areas that actually can add a lot of value. So let's make sure that we're talking about that too, not just about the investments. Contact information for us, we'll pop back to that in a second. And again, the attorneys are very happy when we show these slides. These are the disclosure slides, which have some footnotes from some of our sources. And also to reiterate, these are just our opinions and not guarantees of anything that may or may not happen. So with that, we've got some questions.
Absolutely. So actually, yeah, George has a good question here about money growth. So that kind of money supply, right? Read on your chart that there was a 25% growth followed by a 2% contraction. Isn't that still significant money growth?
It's true.
That is absolutely, George. And that's kind of the whole point of that slide, right? Is that some people would look at that and they look at just the raw number and they'd say, yes, there's 2% contraction in growth. It's only happened 4 other times in history, and that's a terrible thing, right? But when you put it into context, just like you did there, you're absolutely right. So that money supply had grown so much. And yes, technically it has contracted since its height, but that is not a bad thing. It's something that needs to happen. So just be wary of the statistics that you see out there and don't take any single statistic for granted.
Yeah, absolutely. Yeah, and I think the one thing to consider too is that it's true, that historically that may be a signal of slowing economic growth or recession or depression, but we've also never seen that big of a spike in borrowing, in money going into the system at one time. So it is that's true, but we're also kind of in uncharted waters as well. We've never seen a period of time like this where we had a pandemic, we had a complete shutdown of the economy. Never happened before.
Absolutely.
So even in other pandemics, I mean, there have been other things, maybe not to that extent, but we've never seen that kind of a shutdown before. So certainly it's there's always uncharted waters, there's always stuff that happens where the details are different. But yeah, this time around, I think that's pretty important to recognize.
I think it is too. And I mean, that's a good point. We all think of COVID and we say, oh man, that was so long ago almost, right?
I know, I couldn't even remember the name of the virus, right? It's
right. And say, oh, that was so long ago. But I think the fact of the matter is we are still feeling the repercussions of that because again, the government never said, we're just going to shut everything down and see what happens.
Yeah.
Right. We're going to throw a ton of money at the people while we're shutting everything down and we're going to see what happens.
Yeah.
And so, yes, we are still very much in those COVID times, if you think about it, as far as we are economically and financially.
Yep,
So.
for sure. Yeah, and still, some of the money we talked about before, some of that money is still sloshing around. In other words, people haven't. If you kind of look at the trillions of dollars, people, the stuff that went into people's pockets, it hasn't all gotten spent yet. It's getting there, right? Maybe by the end of the year is what experts are predicting, that'll be kind of sopped up at that point. So I think that's part of the reason why we're seeing inflation numbers drop as well. That's starting to get back more to that even point.
Absolutely.
Yeah.
Absolutely.
Good. What else? What other questions do we have?
You know what? No other questions. We still got a couple minutes. Otherwise, you can see on the screen there all of our contact information. So you can always feel free as well. Email Josh or myself. Tell you the truth, usually it's better if you email both of us.
Yes.
That way you will increase your chances of a quick reply. Otherwise, phone numbers on there as well. So any questions, especially for those of you who are watching this after the fact, if you do have any questions about anything you saw today, or anything in general, please reach out. We will be happy to answer those for you.
Yep. Absolutely. And it's certainly fun to, right now, it's certainly fun to be flying the plane when things are going well. But we're always here for both circumstances. We want to celebrate these times, and during years like 2022, equally important to make sure that you've got good experienced pilots flying the plane. That's one thing I think AI, we've talked about that. It's like if AI could fly an aircraft, and I'm sure it could, right? Would anybody want to get on the plane? Probably not.
He's scary.
Probably not. I think even though we know, intellectually, we know that autopilot probably flies that plane right now a bunch of the time.
Right.
The fact that you've got co-pilot sitting up there, that's comforting, right? It's comforting. So we're here for you. So if anything that comes up, certainly let us know. And as always, any friends, coworkers, other people that that they probably are maybe like those association of individual investors, they probably could use some help, or maybe even they're asking for help. Maybe they're mentioning even that, I need to talk to somebody. That's really why we're here, to help them as well. So just let us know.
Absolutely.
All right.
Well, thank you everybody for showing up today. We had a really great turnout today.
Absolutely.
So we love seeing that. And then everybody who watches it after the fact. Very good.
Yeah, which our statistics say that more people watch it after the fact.
Yeah.
But yeah, for those of you who are listening right now, thanks for tuning in live. It's definitely fun to have the interaction and to be able to see digitally, at least see who's popping in and be able to connect with you.
Absolutely. So everybody have a great rest of your day. I think that's all the time we have for today.
Great.
And take care.
Thanks. Yeah, take care. All right. And for those of you who are still on Facebook land or Zoom, thanks for tuning in again live. Certainly appreciate you and